As the main region for global demand growth, Asia has attracted most of the world's marginal barrels of oil over recent years. Rising production from the Middle East is increasingly finding its way eastwards, as our crude oil exports from Africa displaced from the US by the rise in production of similar light, sweet crudes. Falling oil demand in Europe has prompted British and Norwegian producers to send crude to markets east of Suez, and Latin American exporters are looking to Asia to absorb oil that might otherwise have flown to the US. The result is often that Asian markets are awash with oil, which leaves refiners there spoilt for choice. Exporters find themselves forced to offer discounts to Asian buyers in order to secure their custom, and the outlook is for more oil to start heading to Asia as demand remains weak elsewhere. Discounts are nevertheless little more than a short-term fix for sellers with excess crude. If they plan to increase their shares of the Asian market, or even just to maintain their present positions, they will need to be a lot more creative in their marketing strategies. Asia has seen the highest growth in demand and imports of any global region during the present century. Between 2001 and 2015, demand went up by 11.3 million barrels per day, or 56.9% to 31.3 million barrels per day. The combined increase for the other world regions amounted to just 8.4 million barrels. The Asian share of global demand has also grown considerably, from 36% in 2001 to 67.1% last year. It's now the largest region in terms of demand, having risen from second place behind the US and Canada in 2001. Over the same period, Asian imports of oil have grown dramatically, from 15.6 million barrels per day in 2001 to nearly 29 million barrels per day in 2015, which is a rise of 86%. The largest increase, unsurprisingly, came from China, amounting to 6.4 million barrels per day, a rise of over 350%. Approximately 70% of Asia's imports consist of crude oil, of which the Middle East is the principal supplier with a market share of over 70%. Middle Eastern producers have been able to build up such a large presence in Asia by capitalizing on the region's high dependence of oil imports. Asia's production of 7.8 million barrels a day is sufficient to meet only a quarter of its demand. This unsurprisingly causes concern about energy security in many countries across the region. Middle East exporters have managed to address these fears by offering oil on long-term supply arrangements with evergreen contracts. They have also underlined their commitment to secure long-term supply contracts by leasing storage facilities on long-term basis and allowing governments, in some cases, first call on the inventories kept in Asia in the event of disruption to global supplies. Saudi Arabia and the UAE each have crude storage capacities of around 6.3 million barrels in Japan, with the aim of supplying not only Japan but other parts of East Asia. The Abu Dhabi National Oil Company has a storage facility in South Korea which holds almost 50 million barrels and is looking for sites elsewhere in Asia. In this way, Persian Gulf producers can convert some of their exports from long haul into short haul as far as Asian buyers are concerned, which both improves the security of supply for Asian countries and allows the exporting countries to react quicker to changing market conditions. As Asia's second largest oil importer, Japan is of particular interest to Middle Eastern exporters. Many have a strong presence here already and are anxious to maintain, if not improve it. Japan's preoccupation with energy security, however, is beginning to wane. Poor refining margins and a stagnant domestic economy are causing refiners there to focus less on the issues of security of supply and more on the economics of their operations. For many years, Japan's refiners have felt obliged to pay more than their Western counterparts for Middle East crude oil in order to ensure these long-term supply arrangements. Their willingness to pay a security premium is now a good deal less, and as a result, they are buying more crude on spot, thereby reducing term supplies, and are a lot less conservative than they were a few years ago about running new crudes into their refineries. The view in Japan, and to a growing extent elsewhere in Asia, is the lack of demand growth in many other parts of the world make markets east of Suez increasingly desirable to oil exporting countries. This is indeed the case and is evidenced by the competition from new suppliers to sell to Asia. Among the relative newcomers are Algeria, Angola, Nigeria, Venezuela, Mexico, and old stalwarts the UK and Norway, all of which have seen their exports to the US fall because of the rising production there, and most recently the US itself, of course, where the rules that restricted the export of crude have now been greatly relaxed. A similar attitude is emerging in China, where the deregulation of smaller refineries, known as teapots or tea kettles, has opened up the market for imports amongst refiners that were once recently obliged to buy their crudes and other feedstocks from Chinese state refiners. Teapot refineries have recently been importing crude from Russia, Angola, and the UK. Another country where the market for imports is now opening up is India, where there is the added attraction of being Asia's most rapidly growing oil market. Oil consumption there looks likely to increase this year by up to 0.4 million barrels per day compared to only 0.2 million barrels per day in China. India's main supplier at present is Saudi Arabia. There's considerable competition amongst Middle Eastern countries supplied to India, however, thanks mainly to the rise in exports from Iran and Iraq. In recent years, however, Nigeria has also made considerable inroads into the Indian market, along with other African exporters, notably Angola and Algeria. All three have turned to Asia to replace lost crude oil sales to the US. Nigeria has concentrated on India, where early this year is the fourth largest foreign supplier. Angola has gone mainly for the Chinese market, where it's consistently been amongst the top three foreign suppliers for a number of years. In the first half of 2016, it exported almost 900,000 barrels per day of crude to China, which represented almost 12% of its total imports. West African countries currently export around 2 million barrels per day to Asia in total. Algeria has been able to double its exports to Asia so far this year, thanks to competitive pricing. Its Sahara blend light sweet crude has been making inroads at the expense of some of the exports of condensate, particularly Australia. Asia has been amongst the largest battleground for these light sweet crudes and condensates, prompted by the rise in production from within the Asia-Pacific region and from other areas such as US, Iran, and of course Qatar. The main competitor for African exports, as well as those from the Persian Gulf, is Russia, which exports approximately 1.4 million barrels per day to countries in Asia, either by pipeline or by sea. The main overland link is a pipeline from East Siberia to North China, which carries just shy of 500,000 barrels per day, and there's also a smaller overland link to China via Kazakhstan. Of Russia's total Asian exports of 1.4 million barrels per day, for the first 18 months of 2006, some 1.1 million barrels went to China. Russia has plans to export more crude oil to Asia, and of course there's the political as well as economic reasons behind this. Hostility on the part of the European Commission to Russia has led to calls for the Commission for the European Union to reduce its dependence on Russian energy. Russia therefore actively pursues a policy of increasing the proportion of its oil exports to Asia, and we can expect to see this increase over the years to come. As part of this policy, Moscow is adopting its domestic crude oil pipeline network to allow more Russian crude to be transported eastwards, including the building of new pipeline capacity. The Russians hope these measures will provide them with steady and rising exports to Asia on a long-term basis, making their exports less reliant on spot sales and therefore less volatile in terms of their volume. Exports to Japan and South Korea in particular have fluctuated in recent months as refiners there have switched spot sales between Russian and Middle Eastern crudes. Moscow plans to lock in more export volume on a steady long-term basis by making them part of a more comprehensive trading arrangements where possible. These include export deals linked to the investments by Russian companies in Asian refineries and allowing Asian firms access to Russian oil through their involvement in upstream projects in Russia. Asia's dependence on imported crude is expected to increase as demand grows and local production goes down. This should create export opportunities for a number of oil suppliers, and the volume of crude imported is likely to continue to increase. This year, for example, China's Teapot and other independent refineries have been importing 4 times the number of crudes they did in 2015-16. For all of this, though, the Middle East looks to remain and retain its dominance as a supplier of crude oil as countries there battle to protect their market shares, discounting their prices where necessary. Middle Eastern exporters also have greater capacity to increase their oil production, unlike many of their rivals. Supplies from Africa, Latin America, Australasia and the North Sea are not expected to rise by very much. Russia should be able to continue exporting more by diverting exports away from Europe and towards Asia. The US, of course, has room to add to its production and exports when global crude prices go up and stay up, but the principal gainers will nevertheless continue and remain to be the main exporting countries of the Persian Gulf.